Hi there, this is my stocks portfolio update for the month of January 2022. And what a month it has been. There's a lot to talk about, so let's get right to it. January 2022 was a very bad month for the stock market. News reports describe it as dismal, brutal, and as the worst month since March 2020. The Dow Jones down 4%, European shares down about 6%, the S&P 500 down 7%, and the Nasdaq even 10% decline. And it would have been even worse if we didn't end the month on a note of optimism. So right now, stock markets are rising again. Investors are buying the dip, but I am quite sure that the worst is yet to come. The reason for the sell-off is, of course, the Fed. The Fed is anticipated to tighten monetary policy, and inflation and the Fed's reaction to inflation in the form of faster tapering, higher interest rates, and quantitative tightening remain the number one topics that drive the stock market. I am not at all surprised that this is happening. The anticipation of less loose money is causing these problems. That's pretty much what I expected. The consequence is that certain kinds of risky, high-flying, speculative investments are coming under pressure. And as long as investors expect the Fed to continue to tighten monetary policies, these kinds of stocks should continue to perform poorly. So, for instance, Tesla, one of the most hyped companies out there, down as much as 15% this month, or Twitter, the epitome of a tech stock, down as much as 23%. And of course, Bitcoin, perhaps the most speculative investments of them all, had a huge crash this month. Instead, what people want is value stocks with solid earnings, more defensive, more conservative, with pricing power so that they can pass on higher costs to their consumers, also international stocks, and of course, stocks that pay a solid dividend. For instance, British Petroleum BP pays a 4% dividend, up 10% this month. Now, that's not really my kind of stock because that's an oil stock, a fossil fuel companies, and I don't want to invest in those. Or British American Tobacco, 7% dividend, up 14% this month. Once again, not really the company that I want to invest in. Cigarettes, cancer, not really what I want. But it shows you that there is a rotation going on. That was a big keyword in January 2022, rotation. People go from growth and momentum stocks to value and dividend paying stocks. And that is pretty much how I wanted to invest anyway. Those are the kinds of stocks that I have. I try to do value investing. Don't know if I succeed, but at least that's my strategic idea. And as a consequence, the market sell-off did not really affect me very much. I am more or less flat on the month, but I did foresee that people eventually would want to get out of these frothy growth names into more solid value stocks. That's what I said in my very first vlog when I bought my first stock, GlaxoSmithKline, in March 2021. And then lots of investors will want to buy a stock like this because they think it's undervalued and it's part of this restructuring from growth stocks to value stocks. So I am planning to continue to invest in value stocks. And that's what I did this month because I bought some shares in Unilever. Unilever is a British-Dutch consumer goods company. They are known, for instance, for brands such as Dove soap, Lipton tea, or Magnum ice cream and stuff like this. And they pay a very nice dividend of about 4%, not too shabby. They had been on my watch list for a while, but then what happened was that on January 18th, they made a £50 billion offer to take over the consumer arm of JSK. 50 billion, that's a lot. And so the stock tanked by about 10% that day. And that's when I decided to take advantage of the situation and buy. The stock has since recovered, so I'm actually up at the moment, which is good. And I bought 14 shares for £514. So yeah, Hopefully, they will continue to make good money with their consumer products. Good earnings are now more important than ever. And if it works out, then more investors should want to buy this company in the future. And while I'm waiting, I'll just collect their dividend. So I am quite happy to have some shares of Unilever in my portfolio. Now, as I have said before, my expectation is that we will continue to have high inflation. December inflation was 7% in the US, 5% in the UK, and also 5% in the Eurozone. That is very, very high inflation. US inflation is expected to come down to 4.9% in January. We'll see if that happens when the numbers come out later in February, but that would still be very high. And these high inflation numbers should in principle be good for commodities and in particular for gold, but instead gold prices are still falling because investors believe the Fed. They say that they will tighten monetary policy and that inflation is just due to the pandemic, to supply bottlenecks. And when the pandemic subsides, inflation numbers will go down again in Q2, in Q3 of this year.
And that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter.
And investors just believe it. The majority of investors think inflation will actually come down again, and so they are selling gold.
The outlook for inflation now running at 7% year over year is for a decline to 4.2% this year, 2.9 by end of 2023. So the more dovish outlook on rates comes, at least in part, with a belief inflation will come down.
But I don't think these investors are right. Sure, inflation may come down a little bit from 7%, but my prediction is that inflation will stay elevated for a long time, and it may rise even beyond 7% eventually, maybe in 2023, 2024. So first of all, inflation is in producer prices. Input costs have risen, so that's already in the pipeline, and then only later are these increases passed on to the consumer. Secondly, inflation isn't just in products associated with supply chain problems or with the pandemic, it's widespread. Rents are going up. I mean, rents are not really a supply chain issue. Food costs are going up, and that causes so many problems for poorer people all around the world. Service prices are going up. For instance, a famous story this month was that Netflix is increasing their prices by 10%. Commodity prices keep rising. Lumber prices, okay, they have come down, but now they have also been rising again. Research and development costs are being reduced. Why? Because they're too expensive, and so on and so forth. Lots and lots of different prices, products and services and commodities are all rising. Third, wages are going up. Okay, so that can create a spiral. Wages are going up, prices are going up. Wages are going up, prices are going up. And I think there's a chance that we are already in this mechanism now. And there are other reasons too. Higher interest rates, that's a cost. Servicing your debt, that's a cost. Oil and gas prices are going up, supposedly because of, Ukraine and, international tensions. There are labor shortages, resource depletion, and climate change, which will cause so many problems. So I think inflation should be a much, much bigger worry for investors.
We have a lot of inflation that is embedded in.
So on the one hand, inflation might be higher than what the market expects, but then there is an additional problem, namely monetary policy may not actually become as tight as the market expects to fight inflation. I mean, I've heard some extreme calls on how tight the Fed might get. 3 hikes, okay. 5 interest rate hikes, I don't know, 7 hikes, 8 hikes.
The problem for the Fed is there's not a punch bowl to take away. There's barrels of punch that they've got to get out of the system. I mean that the Fed has a lot of rate hikes ahead. And the more aggressive thing, which I think they need to talk about, is to end QE now and do the first rate hike and get in 8 rate hikes this year, get to a 2% Fed funds rate.
But the problem is, if they actually did this, it would cause problems in the economy. Stock values would continue to go down. At the moment, it's these expensive momentum tech stocks or crypto. And as I said, I expect this decline to continue as long as the perceived wisdom is that the Fed will tighten a lot. But then later on, it would be other stocks as well. If you can get 2% from a bond, why would you buy a company with a 2% yield if it trades at, I don't know, 30 times earnings or something like this? The 10-year Treasury has now risen to 1.8%. That's already within my expectation for the end of the year, namely 1.75 to 2.25%, like I said in my last vlog. These higher rates would be terrible for the stock market. But many people depend on their stock portfolio, pension funds, for instance. What about the housing market? Higher mortgage rates could lead to a situation like in 2008 all over again. Government debt, I mean, how is the government supposed to finance their operations? And also there are a lot of companies that basically have no earnings right now. There are zombie companies that wouldn't even exist if it wasn't for these extremely low interest rates. And so if rates go up, they will have to cut back, lay people off, maybe even go bankrupt. So that's not good for the economy. That smells like a recession. And what about the wealth effect? If asset prices go up, people feel wealthier. But if their stock portfolio or their house value goes down, that doesn't feel so good. So people will spend less. And in an economy that's basically based on spending, that spells trouble. And also, if interest rates go up, that could invert the yield curve. And that's certainly something that the Fed does not want. So what all of this means is that interest rates can't really go up too much. It would risk a recession. In fact, high interest rates, I think, could easily be catastrophic for the economy because there is so much debt. Therefore, my prediction is that at some point, perhaps at a level of 1%, the Fed will speak more softly, halt the interest rate hikes, and then support the markets again so that they don't fall any further. Now, before that happens, there needs to be a lot more pain. So it's very hard to time this. But at the end of the day, they are not going to raise rates much beyond, I would say, about 1%. That will be it. That's my assumption.
Because I think what's actually going to happen is that the Fed's going to move a couple times and then wait and see how it affects the markets. As it starts to hike rates, if that spread between the 2-year and the 10-year gets too narrow, or we start to approach an inversion, they're probably going to back off. So I think 5 hikes might even be a little much. 7 hikes, in my opinion, is definitely a little much.
So on the one hand, the markets expect that inflation will subside, but my expectation is that inflation will be much more persistent. And on the other hand, the market expects that the Fed will tighten until the inflation problem has been brought under control, whereas I think that there will not be much of a tightening cycle beyond maybe 1% of a Fed funds rate. And so then after that, essentially the Fed will move back from tightening to easing again. If these predictions are correct, then there is a really great opportunity in things like commodity stocks and in particular miners and precious metals. This is, of course, extremely risky. It is absolutely possible that my predictions are completely wrong, but I still think it is worth this risk. And so my plan is to continue to buy commodity stocks and precious metals miners, because I think these companies are extremely undervalued at the moment and they could go up a lot. Many also pay good dividends, so I can still get paid while I wait. And so despite the fact that there are some nut jobs out there who advertise gold for sort of conspiratorial reasons or dubious reasons, I will continue to invest in them. So another thing that I did this month as well is I took another £500 from my savings. After all, if I just leave it in the bank, it looks like I will lose about 5% of my purchasing power to inflation anyway, so I might as well invest it. And what I did is I bought another gold company. It is called Sibanye-Stillwater. They're based in South Africa, and I think they're just insane. They have a dividend yield of, get this, 11%. That's huge. And a PE ratio of about 3. Right? So cheap. So it looks super suspicious. It looks too good to be true, but I checked it out. And as far as I can see, it's fine. Their payout ratio is about 50% of cash flow, and they do have a healthy profit. So I didn't really see anything wrong with it. It seems like the company is just extremely cheap or unpopular. So I bought 50 shares for about £500. And in the month of January, it's actually gone up 15%. So that's also insanely good. So I'm off to a very good start with this one. And yeah, I hope it continues to develop positively like this. We will just have to wait and see, because these sorts of stocks are extremely risky and they can be very volatile. But anyway, this is the second company I bought this month, Sibanye-Stillwater, and I am quite happy with this purchase. All right, then all that's left for me to do is to report on the current value of my portfolio. As of today, February 1st, 2022, my portfolio has a value of £17,536.91. My performance is still pretty bad. I'm still very much in correction territory. I'm down 13.84%. That's slightly worse than 1 month ago, but less than 1% more in the red. So I'm still optimistic that in the future, I can improve my performance substantially. All right, that's all for today. The casino of the stock market continues to be extremely exciting. I'm enjoying this experience, and I'm looking forward to seeing what happens next month.